I am very much one for metaphors and weirdly connecting things. So I'm going to start off with another weird connection. About almost 200 years ago, Frederick Douglass, a great man who we all know, who is, I would say, one of the founding fathers of Black America, he taught himself how to read. And reading and knowledge was something that was forbidden for slaves to know, for slaves to possess. But through this act of resistance, through this act of really self-preservation, he taught himself how to read, and thusly he taught himself how to make a plan to escape. And he ultimately used that tool of literacy to help him gain his freedom and be part of the abolitionist movement. And now the weird roundabout way that I connect those two is, well, financial literacy is something that is very, very, very important for the Black community, because it's honestly something that a lot of us are lacking. And that is very, very intentional, because look back on it, we were traded as capital. And then when we were finally free, we were not allowed to really have anything. Our former masters were given reparations, but we were not. We had almost no understanding of these systems that we were just expected to understand, even though we were not provided any sort of education in any of these matters. And so now the reason we are really trying to bring up these topics and help educate the community is so that we can finally gain that financial literacy that we should have had so long ago, and that should have been taught to us so long ago, and that the American education system fails to teach us. Like I myself, the only way I'm able to do taxes as a grown man is by using TurboTax, and I'm sure that's how a lot of you are as well. But that shouldn't be the way. We should all have financial literacy. We should all have just these tools, these intricate little tools that mean so much in a capitalist society. And while, yes, we do eventually want to get a point where there is some, I'm not saying like a big guns blazing revolution or anything, but I'm saying a social revolution where we finally have the tools, where we are not limited by our government, but we are supported by it. But until then, we are going to keep on holding events like this to really put forth and uphold our community so that we can have a fighting chance. The black dollar is the number one spending power, and part of that is because we built this. We built this country. We built the buildings that they vote within in Washington, D.C. We built most of the Eastern Seaboard after it was stolen from Native Americans. And our dollar means so much because we have so much less than we do deserve, because we still have not been paid for what we built. Yeah. And thank you, everyone, for coming and watching this right now. And without further ado, I'm going to introduce our musical guest, Angel Hudak. So Angel is a 19-year-old vocalist from San Diego, California, and she's been performing for the last 9 years. She specializes in singing R&B, soul, and jazz, and she's found inspiration from modern R&B artists, including Ravina, Mac Ayres, and Snow Allegra, but will forever look up to legends like Whitney Houston for musical guidance as a performer. She hopes to find success in the music industry after her completion of her musical degree. And take it away, Angel.
Hi, everybody. If you can hear me through the microphone, please give me a thumbs up. Awesome. Thank you so much. And yeah, once again, my name is Angel Hudak, and thank you guys so much for coming to this event tonight. I'm really excited to perform for you guys. I've got a few of my R&B favorites prepared for you guys, so I hope you enjoy. And so my first one that I'm going to be starting with is I Want You Around by Snow Allegra. It's not that I don't want you here. It's something about the way you stare into my eyes. I know that I don't make things clear. I fall for you every time I try to resist you. We get away, palm trees, beach views, ordinary day. All I wanna hear is inner visions on replay and sit right next to you. I'm not too sure how I feel about you, thinking we should wait, but I don't really wanna. I just wanna get away and sit right next to you. I don't wanna kiss you, yeah, I just wanna feel you, feel you. I want you round, around. I want you round, around. I want you round, around. I want you round, around, around, Come through, I think I need you here. I swear it's hard to keep these feelings to myself. You know what I'm thinking of. My higher ground, my rocky love. Fuck gravity, I'd rather stay out here. But we could get away. Palm trees, beach views, ordinary day. All I hear is inner visions on play. And sit right next to you. I try not to show how I feel about you, thinking we should wait, but I don't really wanna, I just wanna get away and sit right next to you. I wanna kiss you, I just wanna feel you, feel you. I want you round, around, 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 All right, everybody. So that was I Want You Around by one of my favorite girls, so Miss. And for my next piece, I'm going to be doing a blues song by Corinne Bailey Ray. And she's incredible. If you don't know her, she sings Girl Put Your Records On, which is a favorite. So this next one is Closer by Corinne Bailey Ray. I don't want to give you up. I don't want to hold you up. I don't want ambiguous. I just know that I've had enough. I want you to travel with me. Let loose and let your mind go free. Show you things that you never seen. And you just got to go, yeah. Your love is so good, and I wanna show you. Don't make me responsible for something that you can't find. Ooh, your love intimate. I want it near at hand. I wanna get close to you, babe, experience. I want it generous. Lay it down, what's impeding you? Cause I wanna get close to you. I don't want to give you up. I'm tired of the pull and push. I'm tired of the making up. Don't you feel like you had enough? I want you to travel with me, explore all of the hidden scenes. I don't mind just a bit of attention if we get to love in the same direction. Oh, your love is so good, and I wanna show you. Don't make me responsible for something that you can't find. Ooh, your love is so good, yeah, closer. I want it intimate. I want it near at hand. I wanna get close to you, babe, experience. I want it generous. Lay it down, what's impeding you? Cause I wanna get close to you. Yeah. I wanna get. I wanna get. You just got to go with me. Oh, your love is so good, and I wanna show you. Don't make me responsible for something that you can't find. Ooh, your love is so good, yeah, closer. I want it intimate at hand. I wanna get close to you, babe, experience. I want it generous. Lay it down, what's impeding you? Cause I wanna get close to you. I wanna get close. I wanna get close. I wanna get close, closer. I wanna get close to you, baby. You, baby. You, baby. You just got to go with me. Thank you, everybody. Thank you so much. I appreciate all the love, all the hearts, all the thumbs up and everything. So thank you. So for my last piece of today, I'm going to conclude it with, I think this is everybody's favorite. This song has been my favorite since I was a little girl. Miss Alicia Keys' album, I fell right in love with it. So I'm going to be singing If I Ain't Got You by Alicia Keys. Some people live for the fortune. Some people live just for the fame. Some people live for the power, yeah. Some people live just to play the game. Some people think that the fancy callings define what's within. I've been here before, but that life's a bore so far. some people need 3,000 roses, and that's the only way to prove you love them. Hand me the world on the silver platter, and what good would it be? No one to share with no one who truly cares for me. Some people want it all, but I don't want nothing at all. If it ain't you, baby, if I ain't got you, baby. Some people want diamond rings, and some just want everything, but everything means nothing if I ain't got you. Some people want it all, but I don't want nothing at all. If it ain't you, baby, if I ain't got you, baby. Some people want diamond rings, and some just want everything, and everything means nothing if I ain't got you. If I ain't got you, baby. Oh, ooh, see nothing in this whole world don't mean a thing if I ain't got you with me, baby. Thank you so much for letting me perform tonight and for watching me and listening. I really appreciate it so much. And to conclude this section right here, I want to introduce a moment of silence for Black lives. So if we could all take a moment of silence.
Okay. Thank you, everyone, for taking that part in that moment of silence. And thank you so much, Angel, for that amazing, amazing performance. God, this may be an event that we're doing on Zoom, but oh my God, you brought my house down. I think you brought everybody's house down with this. So thank you so much for that. And sure, you thanked us for having you, but thank you for coming because you brought it. You brought it, girl. But all right, so everyone, without further ado, I would like to give the opportunity for our speaker tonight to introduce themselves. So, Julian, if you'd like to go ahead.
All right. Good evening, everybody. So I just want to say thank you to Zion for introducing the meeting for tonight. And then also Angel for your just amazing vocals, like pop off. Come on. I don't know you guys. It's the first night that I'm meeting y'all. So, but I already feel like so welcome. And just the vibe and the community that you guys have brought together is just truly truly amazing. So I just want to get started. So I'm going to share my screen. Okay. Who here, before we dive into anything, has any sort of like knowledge of financial literacy or anything about finances? Show of hands. Okay, so a few, yeah. I mean, we're all like adulting, right? So it's like that time in our lives. So yeah, so I'm going to share my screen and then we'll get started. Oh, I need the host to allow me to share my screen.
Sorry, give me 1 second.
Okay, no, you're good.
Toggling in between YouTube and here.
Oh, it's fine. Well, while we're doing that, I am Julian. Sorry. I am I was a dance major at Cal State Fullerton. Around the coronavirus time, that's when I got my license as a financial professional through Transformation Financial. Through my uncle, he was invited into the company, and then through him, that's how I was brought on with the company. And yeah, so let's just get started and I'll get to more of that information.
All right, you're good to go, Julian.
Perfect. Thank you so much.
Mhm.
All right. Let's see. So can everyone see my screen?
Yeah.
Perfect. Awesome. All right. So is there like a time frame for this? Like,
You have a whole hour, Julian. So
okay, perfect. Okay,
Yeah.
perfect. That's more than enough time. Okay. So this is a 10-point presentation on financial literacy. So like I stated before, I'm a newly licensed agent as of May of 2020 with Transformation Financial. So has anyone seen this building here before? To the right. It should be familiar. If not, that's okay. It's located in downtown San Francisco. Okay, so just a little bit up north in the Bay Area. So Aegon is my parent company. So if you have never heard of Aegon before, it's a very well-known company in the financial field. Reason being is that it was founded in 1844. Their worth is $440 billion, and it is the second largest company in the entire world. So that's good on my end because that means I will always be employed. We really work 10 times harder in a financial crisis such as COVID. So a lot of my partners and leaders have been working 10 times harder than they were before COVID because a lot of people are really searching for those pathways and those accounts that are going to help them to secure their assets and their finances. So I partner with Transamerica. So if you ever heard, this is the building right here, Transamerica in San Francisco. So I also partner with all these companies listed here. So Everest, Nationwide, Voya, Prudential, Transamerica, as well as 80 other companies like Herbalife. Fidelity is also a popular one. A lot of 401ks partner with different professional companies like Verizon, Disney, those types of companies, MetLife, the list goes on, Gerber. And so I like to call myself the Costco of financial services because if you go through me, I can have you like a wide variety of companies that are able and accessible to you as a client, versus if you were to go to a Nationwide office, they can only offer you those products and those services to you. So I can say, you know, a Nationwide is a good fit for you, but I found a better one at, say, Transamerica or Gerber Life or Fidelity. And so in terms of financial literacy in our country, typically when I ask this question to people, they say that there's just not a lot of knowledge in the finance scope and under the like umbrella of finance, right? That's because 9 out of 10 individuals typically have no financial advisor to guide them and help them to relocate their finances, budget their finances, so that they can be successful and secure their financial wealth, right? So I want to reiterate that a financial advisor is different than a financial professional, which is who I am, financial professional. Reason being is that a financial advisor is one who actually sits down with the client and goes through everything that they do with their finances, like credit cards, bank accounts, how and really manage how they're spending their money. And a financial advisor charges their clients directly. And that's how the financial advisor basically creates commission off their clients versus a financial professional. All I do is provide an education. I help my clients gain a basic knowledge of finances. And then if they're interested in securing their assets, then I'm able to open up an account for them. But I don't go through their finances. I just ask, what is a comfortable amount that you are willing to invest or put away or save per month? And then I work with that number and I find the best account suitable for that client. And I do not charge a service directly with my client. I get paid directly with my own company. So that's how I'm able to reach all different types of people from all different types of communities and financial backgrounds. And so our slogan with my company is "No Families Left Behind." And just like I said before, that's how I'm able to reach people who really do need the help, because a financial advisor charges a pretty penny for their services, whereas mine is more as like an education source. And so in terms of financial institutions, where do people put their money? Well, the first stop would be banks, right? So any checking or savings accounts would be there. There is an interest that banks will credit us as for having an account with a bank, right? So as like a thank you, we're going to deposit so much percentage into your account as a thank you for doing business with us. And so most interest amounts are 0.01 to 0.03% on interest that they give us, right? With a typical savings. So not a lot of interest, but just a little bit, because it's meant for emergency, an emergency source of income, right? And so the next stop, people typically look at investments, right? So any types of 401k plans, mutual funds, bonds, stocks, of course, stock market, even real estate is also an investment, right? And so there's also a third place where people can put their money, but a lot of people just don't know the answer, or they can guess, but they get close, but not quite. And so that third stop is actually in insurance, right? So not many people know this, but you can actually use insurance as a means to protect your money, right? Because we utilize insurance to protect an asset. So that's why we have car insurance, homeowners insurance, renters insurance to protect that asset. So why not use insurance to protect your money? So when I was asked that question, I was taken aback, because I was like, that makes total sense. Why wouldn't I utilize insurance to protect my most valued asset, which is my money, right? And so there are 4 different branches as to why someone would want to invest in insurance. So I'm going to list those. The first one would be financial aid. The second would be bankruptcy. The IRS, and lawsuits. Okay. So the reason why someone would want to invest with insurance is for these reasons. And there's many more, but these are some of the most basic ones that I can list. So financial aid. Say you want to go back to college, or you never went to college, or you have kids that are going to college. The college itself will be able to see that you have insurance, but not the amount that you have in insurance. So you or your child would still qualify for financial aid. Bankruptcy. If you yourself were to file for bankruptcy, the government, anyone out there could not touch your money that's covered in insurance. The IRS, the government, they cannot access those funds. If any reason that you owed money to the government, they cannot access those funds in insurance. Lawsuits. If you're ever in a lawsuit for any given reason, no one can touch that money in insurance. The government, people, they can touch these accounts here because they are considered open accounts. So banks and investment accounts are considered open accounts. Okay, so if you owed money, if you were in a lawsuit, if you filed for bankruptcy, the government, someone who's suing you, they can take out those funds in your checking, your savings, your 401ks, your mutual funds, because they are considered open accounts, but none in insurance because it is covered, right? So the rule of 72, okay, so it's a very prominent rule. There's many rules in the world of finance, but this is one that we as a company like to explain to our clients because it deals with interest. Okay, so Albert Einstein created this rule. So basically, you take the number 72 divided by the interest rate, whatever that interest rate is, and you should equal the number of years it's going to take for that money to double. Okay, so I'm going to do an example in terms of debt. Okay, so as an example, I'm going to take 72 divided by 24 because that's one of the interest rates my credit card currently charges. So if I take that number, that equals 3. Okay, so say I don't pay off my credit card, that means that my debt is going to accumulate in 3 years. And if I don't pay that off, it's going to double, right? Because that's interest on top of interest. So we have a given time to pay off that debt. And if we don't, it's going to double because of that interest. Okay, so that's how a lot of people get into debt with student loans, credit cards, because it just gets harder and harder and harder to pay off that debt because that interest rate is so high. The number of years it's going to take for that money to double shrinks. Okay, so the bigger the interest, the smaller amount of time you have. Okay, so in terms of how it can benefit you, okay, would be here in this example. So this is a typical savings account. I'm just going to say Bank of America, just as an example. So we're going to say that the Bank of America with a typical savings with them is going to give us 2%. So that's being very generous. Obviously, before we stated that was 0.01 to 0.03%. So if you wanted to do that math, that's 72 divided by 0.01 or 0.03, basically it would equate to 2,400 years to 74,000 years. Okay, so basically your money for it to take that time to double is ridiculous, right? It's not going to double in your lifetime or in your children's lifetime or in their children's lifetime. It's going to take thousands of years to double. So that's just ridiculous. So in terms of saving for the future, for retirement, it's just not going to happen because it's meant for emergency, as an emergency source. Okay. But for the sake of this example, we're just going to say it's going to be 2%. Okay. So if you do that math, 72 divided by 2 equals 36 years. Okay, so let's just say you're 29 and you invest 10,000 with a typical savings account from Bank of America at 2% without it growing or decreasing. It just stays at 2%. That means in 36 years, you'll be 65 and that money has now grown to $20,000. Okay, so obviously that's not including inflation, right? Because the cost of living increases every year. Okay, so $20,000 today is not $20,000 tomorrow. So yes, it did increase and it doubled, but that's not enough to retire with, right? So let's just say On the right-hand side, we're going to invest with a financial institution. Okay. So that would be any of the companies that I listed previously, like Transamerica, Fidelity, Gerber Life, Voya, those types of financial institutions. We're going to say they're going to give us 12%. Okay. Real numbers in the last 20 years, it's averaged around 7.94%, which is still really, really well. So if we were to do that same math, right? So 72 divided by 7.84 equals 9 years. So in real life numbers, those accounts have been doing really well, and that interest has doubled every 9 years. Okay. But for sake of this example, we're just going to say 12 without it growing or decreasing. It's just going to stay at 12. Same example, 29. We invest 10,000 into a financial institution savings or account that they have. So basically, that money is going to double every 6 years. So now by the time you're 65, that money has now grown to $640,000. Okay. So does that make sense? Because that was a lot of information. So I just want to double check.
Makes sense to me.
Perfect. Perfect. At any time, if there are any questions, please feel free to just interrupt me and I will go back and clarify because I cannot see you guys. Okay. So moving on. A lot of people don't know this, but behind the scenes, this is what banks do, because banks are corporations. It's corporate America, right? They're not going to do something for us without them having something in return, right? So a bank, when you invest with their typical savings, like $10,000 in this example, they're going to take those funds that you invested with and they're going to relocate them here in a financial institution. Okay. So now they're going to accumulate your money with that high percentage rate behind the scenes. So by the time you're 65, obviously it's time to pay up, right? So they're going to give you the $20,000 with that ridiculously low 2% rate because that's the account that you have. But they literally just made a profit with your own money and made $620,000 because of that high interest rate with the financial institution, right? So my job as a financial professional is people invest with banks and banks invest with financial institutions. Okay, so I want to take the people directly to the financial institution and cut out the middleman, which is the bank, right? Because if your money is going to double on that high interest rate anyway, then it should be yours, not the bank's, right? Any questions thus far? Okay, I'm going to take that as a sign to move on. Okay. So there are 3 different types of accounts out there, right? So the first basic one is going to be fixed. So this will be your typical checking or savings. Okay. So obviously this is the interest rate and it's not very high. It's pretty stagnant. So in terms of interest, it's just not going to happen, right? So the only time you're going to want a fixed account is when you have a car loan or a mortgage, because you don't want that interest rate to increase. You want it to stay the same. So that's the only time a fixed is going to be your best friend, or for the sake of emergency services, right? So that's when you would have your typical savings. The next account is variable. So this is when we start dealing with the stock market. Okay. Oops, go back. And this is typically categorized as more risky because the stock market is like a roller coaster. It goes up and it goes down and it just does what it does, right? There is no rhyme or reason. It just is. Okay. So that's why it's categorized as a more risky type of account. Okay, so these would be 401ks, IRAs, any Roths, so a Roth 401k or a Roth IRA. What else? So those types of accounts would be variable. Okay. And a lot of people don't know that 401ks are in the stock market. I surely didn't. I thought if I had a 401k with my company was Disney. I did work as a Disneyland performer for 6 years. And I knew that my company partnered with Fidelity and they offered 401k plans. But I just assumed that I was part-time, that I just couldn't open up a 401k because I didn't accumulate enough wealth with the company, right? I was just part-time. So I didn't. But I had no idea it was in the stock market. I just thought if I opened up one, then I was going to have 401k by the time I retired. But that's just not the case, right? So the next account that's out there is indexed. And this is where a lot of people just don't really know about, right? Unless you took like a finance class, then you'd be a little bit more in tune with index, right? And so this is how this account works. So it shadows the market, but is not in the market, okay? So to further explain, when the market does really well, this account is going to do really well too. So you're going to get those gains. But now when the market goes down, it's going to lock in those gains that are in this account. And so you're not going to lose any money. Okay. Now, when I typically talk to potential clients, they say, oh, well, how does that make sense? You know, why am I losing or decreasing in value in my variable account, but my index account over here is going to stay locked in? I'm going to not lose any gains that I had previously had. Well, just like everything else, there's a catch, right? So a catch with fixed is there's just not a lot of interest, right? The catch with variable, it's risky. It goes up, it goes down. Now the catch with index is that there's a floor of 0.75% and a cap. And that cap is 15%. So the most interest you could ever gain on in this account is 15%. And the least you're going to get in this account is 0.75%. So to further explain, when the stock market does say negative 30%, because it's below 0.75, you're going to get 0.75. So you're actually gaining interest where everyone else is losing, right? And then let's just say the stock market does 10%. Well, it's below 15, so you're also going to get that 10%. But now say the market does 20%. Well, since it's above the 15, the most you're going to get is 15. And then the remaining 5% is going to go to that financial institution that you have this account with. So that would be Fidelity, Transamerica, Nationwide, those types of financial institutions. So not only is that how they're able to stay afloat and stay in business, but that is also how they're able to cover you in those losses and make sure you're guaranteed that minimum of 0.75 when the market does tank. Okay, so does that make sense so far? Okay, moving on. So now I'm going to talk about taxes, okay, and how taxes work in each account. So taxes. In a fixed account, you get taxed now, right? So in a typical W-2 type job, right, where you get a direct deposit from your employer, typically that money has already been taxed. So that is taxed now. Okay, so this money going in to this account has already been taxed. So that's taxed now, and a portion goes to the government, right? Now, variable is taxed later, okay? So when you contribute to a variable account, that money has not been taxed yet. So that's what the white is, okay? So this is pre-tax money. Okay. So let's just say, had I opened up a 401k at Disney, a portion of my check would go to my 401k. So let's just say I got 300 for the week. So then, and I wanted a specific dollar amount to my 401k, and I said 50. So every paycheck, $50 would be contributed to my 401k. So then I would get taxed on 250, not 300. Okay. So $50 would go into my 401k that has not been taxed yet. So when I want to withdraw from my 401k, that's when I start getting taxed on those high gains that have accumulated over time, right? So that could be $100,000, $250,000, whatever amount that has accumulated over time when you retire and now you're withdrawing, that's the amount that's going to get taxed, okay? And typically in a variable account, it is an age-based account. So technically in these accounts, like a 401k or a typical IRA, you're not supposed to touch it until 59 and a half, okay? Because it's meant for retirement, right? And now, say there's a crisis or something and you need to withdraw those funds from your variable account, but you're 54 or you're 48. Well, since it's your account, technically, legally, it is yours. You can do that. But because you're touching it early, we're going to penalize you 10% in fees. Okay. On top of taxes, and taxes right now, today, are 20 to 30% in taxes. So if you're below 59 and a half and you touch that money, technically, at least right now, you're going to be paying between 30 to 40% in taxes and fees, right? But if you are 59 and a half or above, you don't have to worry about the 10% anymore, and you're just going to be paying the taxes, whatever tax rate that is. Assuming taxes will stay the same, that'll be 20 to 30% in taxes, okay? Now, a Roth acts differently, okay? A Roth is pre-tax money, okay? So if you wanted a Roth 401k or a Roth IRA, those accounts would still be variable. They're still risky. They're still in the stock market. But when you withdraw from that account, that is essentially tax-free, which also falls in the index category, which is tax advantage, okay? So like I said, when you contribute to an index or a Roth, technically that money has already been taxed. So basically you're contributing directly from your checking or your savings when you contribute to your index. Okay, so that money has already been taxed. So now when you want to withdraw from your index account or your Roth, that money is now tax-free. Okay, so that $100,000, that $250,000, that is all yours, 100% tax-free. Okay. But with a Roth, there are still age limits and things like that and fees. But with the index, that is all your money. Okay. Any questions so far? That's a lot of writing. Okay, moving on. So this is a fidelity statement with one of my leaders' clients, right? So their information is scribbled out, so privacy. But she's allowed us to use this as an example for our presentations. So she partnered with Fidelity, a very popular company in terms of 401ks, right? So employee contributions, this is what she contributed herself to her account, which is $1,100 roughly for 3 months. This is the span of January to March of 2020. So this time last year, right when coronavirus was just getting started, right? Employer contributions, This is what her employer matched her. So a lot of times when you work for a company that offers a 401k plan, they're going to say, oh, well, if you open up one with us, we can match you, right? A certain percentage. Some say 4, some say 6. It just depends on the company, right? So they matched her $3,100 for the span of 3 months. Okay. So loan repayments. She also had a loan that she was paying off in addition to her 401k plan that she attached. So that was $2,000. I'm also going to zoom in here. So if you add these numbers up, roughly she was paying around $3,100 for a span of 3 months. So roughly $1,000 a month. Okay. That she was contributing of her own money, right? So when you look at change in account value, look at that number. She lost $22,000, over $22,000 because the market went down 19.8% because of coronavirus. In a span of 2 to 3 weeks, in that crazy time when it became, quarantine and lockdown, she lost 22 grand. That's someone's salary. I don't even make that much. Not at Disney anyway. And that's just insane to me, right? That's not including her husband. Her husband lost 10 grand. So as a household together, they lost well over $32,000 as a household, right? So this example, I like to showcase this because these are real numbers, number one, but also what if she was of retirement age, right? She's still young, so she still has time to contribute. She has the luxury of losing money because she can gain that money back in X amount of years. But what if she was 65? What if she was ready to retire? She can never regain that money that she lost, right? That 32 grand, that's just gone. So there are ways to help relocate funds from a 401k or an IRA into a safer account once you get closer to retirement, that I can also do with my clients, and that I also encourage people to do that do have 401ks. Not that they're bad, they're really good while you're young because you have those potential for really high gains. But when it's time to, retire 5 years into retirement, you want to think about it. Let's start thinking of better ways to secure your assets, right? So you don't lose anymore, right? Because it can really change and affect the way someone retires. That's why a lot of people who are old work at Walmart, or they work at Disneyland at the ticket booth or the photo booth, because they just don't have enough to retire, right? Especially nowadays. It's crazy with inflation and just everything goes up, right? So I'm going to go to the next example. I'll discard. Play. Okay. So this is a 100K investment comparison in a 20-year span. This is the average stock markets, the major ones. So that would be S&P 500, which is us, the European, and the Hang Seng, right? Okay, so then the next column, this is 100K invested that you have. So this would be your variable account. So that would be your typical 401K or IRA, right? An IRA is an individual retirement account. It acts the same way as a 401K. The only difference is 401K is offered through an employer, and an IRA, an individual retirement account, is something you open yourself. So someone who's like a self-contractor or something like that, they would typically open up an IRA, okay? But it acts the same way as a 401K. And then the next column is your index. So your floor is 0.75 and your cap is 15, okay? So in a 20-year span, we're going back to the 2000s, okay? So in the last 3 years, 2000 to 2002, the market went down an average of 49% in a span of 3 years. Okay, so from your initial 100K investment that you had with this account, you now have 57, roughly $58,000. Okay, in comparison to your index, you actually gained 2,200, a little over that, because of that floor. So you gained a 0.75 here, you gained a 0.75 here, and you also gained 0.75 here because it went below that 0.75 floor. Okay. Now in 2003, the market did really well. It did 23.8, okay, on average of the major three. Okay, so obviously you're going to get that really high gain in your variable account. So it went back up just a little bit, not too much, but it still went up to 71,535, right? But if you look at your index, you're still well above the variable account. However, you only got 15% here because you're capped off at 15, right? So then the remaining 8.8% that you did not get went to the financial institution that you had the account with, like Transamerica, Fidelity, Gerber, any of those accounts, right? So now if we go forward, it took 7 years for the stock market to go back to that initial 100K investment. So when we talk about interest in the stock market in particular, the market never does 100% of what it lost in the next year. It takes several years. It takes time. So in this example, on the left-hand side, let's just say I have $100 and I lost 50%. I now have $100. I mean, sorry, not 100, excuse me, $50, right? Because I lost half, right? So now let's say I'm going to gain 50%. How much do I have now? Well, some people say I have 100. And some people say I have 75. So what's the correct one? Well, the correct one would be 75. Reason being is that this is 50% of 50. What's half of 50? 25. So that's where I get 75 from. But people think that a negative and a positive outweigh each other. And now I'm back at the $100. Simple math. But that's just not how the stock market works. That's just not how real money works, right? So basically, if I wanted to go back to my initial $100 that I had, the market has to do 100%. Because what's 100% of 50? 50. So 50 plus 50 equals $100. But the stock market never does 100% of what it lost in the next year. It takes time. So in this case, it took 7 years, right? 2008, market went down again, 40%. In the last slide, and it took 3 years to go down 49, whereas 2008, one single year, it went down 40%. So now you have 67 grand, roughly 68 grand in comparison to your index. And now fast forward to 20 years, look at the major difference between the two accounts. Your money almost, well, it quadrupled, but I don't even know how to say the 5, like, I don't know, like 5-dupled. Like, it is insane how much that money has gone up. And really, the only main reason is that simple 0.75. If you really think about it, the market didn't really go down that much. It went down 1, 2, 3, 4, 5, 6, 7. It went down 7 times in 20 years. But look at the major difference, right? Because we never know how much it's going to go down. So when you look at your index numbers, notice how it's always growing. It's never going down. And again, it's because of that 0.75. And then of course your cap, 15. It doesn't seem like a lot, but when you look at real numbers, it is a lot. It is a huge difference, right? And so that is basically where I'm going to leave off for today. I hope you enjoyed the presentation. And if you ever have any questions or any other concerns or comments, please feel free to look up my Instagram. And you can DM me and we can, talk one-on-one. Any further questions or someone who needs this information, by all means, hit me up and I'll do the same thing. And if you're interested in opening up an index or an IRA or 401k, I can do that too, right? So, and I don't deal with your finances. I just ask what's a comfortable amount that you're okay with to save. And I work with that. And we create a plan for you that's best for your financial needs and your financial goals, right? Because I feel like this information is so crucial because everyone deals with finance. I'm an artist, I'm a dancer, but I still have to deal with finances. Someone who is, working in concessions, working as custodial, working, any job, we have to deal with finances, right? And it's a serious subject. And a lot of people don't like talking about it because they feel vulnerable, right? They don't want to disclose any information that they deem sensitive with their finances. And so I don't deal with that, right? I just ask one simple question. And I do not charge for a service. And then luckily, I actually do have a client who is here in this meeting. I helped her out. When was it? The summer? Yeah, it was a summer.
Yeah.
Her name's Brandy. Here she is. So if you want to open up about your experience, anything from when I first messaged you to opening up your own account, by all means, share.
So first and foremost, 11 out of 10, 100 out of 10, highly recommend. Open up an account with Julian, do it. I'm just someone who is naturally bad at finances. I'm not good with money. I was very afraid to admit it at first. I'm afraid of money. I still have trouble talking about money. But Julian messaged me about just he didn't even just say, hey, let me help you open an account. He just said, let me talk to you and give you this information and you can make a decision from there. And he threw the numbers down and I said, I could not be poor. And honestly, truly changed my life. Especially because a lot of times as artists, as younger people, we're not going to have health insurance. We might not have the best health insurance. We might not have life insurance. We might not have benefits through our jobs. If you're an artist, most times you're not going to get that through your employment. You got to be working 52 weeks a year. That has to be your contract in order for you to probably get that. So it just helped me figure out a way to make sure my life is secure. If something happens to me, there's a way to pay for the things that happen to me. At least sit down and talk to Julian about what you can do for yourself, because I know I am a little older than you guys because I'm 25. You guys are a few years younger than me. And so even just paying into my index account, that might be what you're paying in might be a little less, and it might be more financially available for you. Because I'm gonna be honest, I pay $50 a month and my life is insured by the time I'm 65, because I personally plan on not touching it unless it's a full-on emergency. I'm gonna have a stack of cash and I'm gonna retire. So do it. Make sure your life is secure, because you don't know what's gonna happen to you. So you wanna make sure you have a lifeline.
Yeah, and I know specifically with life insurance, the younger you do it, the better, because once they'll get all your health information. If I do it now, I'm about to turn 21, even if I'm 50 and I'm gonna try and get a new life insurance policy, they will still use the information from what they got from when I started with them, or started my first life insurance policy at 21, because like that's all they got and that's all they are allowed to use. So if you're going in there at 50 trying to get a policy as opposed to or in your early 20s, you're going to have a lot more trouble and much higher rates, because you could have a whole host of problems that you don't even know that you could have, as opposed to now.
Oh, and then just for like more, just make it more appealing. People with money do this for their kids. The kids I teach at the studio, where I know their parents got a lot of money, all their lives are insured. They have plans set up just like this, because that's what people do. When they have money, they make sure their kids are gonna still have money. They're gonna make sure their kids are insured.
Yes, so there is so much more to the presentation that I can go more into. If anyone else is interested and they want more information, I'm more than happy to give that information out. I mean, that's my whole job. But like Brandy said, like, yes, there are families, the wealthy, corporations even, that invest with these types of financial institutions because it is ridiculously high in the interest and it is covered. Okay, no one can touch this. If, like, bankruptcy lawsuits, McDonald's, Disney, Nike, Amazon, and the Nestle, these corporations invest with these companies and secure their finances. I mean, have you ever seen an AT&T go out of business? Disney, Nike. But have you seen Toys R Us around? Have you seen Mervyn's around? They did not take those financial steps to secure their funds, and that's why they went bankrupt, right? The wealthy, they make sure that they have life insurance policies, their kids have life insurance policies, that they're covered. That's why they have inheritance in the family, right? Like, I've never had an inheritance. I did not know what an inheritance was until I became older, and I was like, why don't I have one? Like, it makes no sense. But that's because there's just not a lot of knowledge, because of the fact that if everyone knew about it, then no one would gain anything, right? And so I'm here to, give out the knowledge and to help people, because ultimately, like, that's my goal, is to help as much people as I can and give out the information. And as long as I give it out, I'm doing my job. You do what you want with the information, because I mean, it's your choice in the end, but I just want to make sure I'm doing my part in relaying the information. So thank you for having me tonight. So thank you.
Yes, of course. Thank
Thanks,
you
Julian.
so much for this, Julian.
Thank you.
Yeah, that was really great, and I took notes, but my notes definitely weren't good enough. So I'm probably gonna go like over and over through the YouTube video that we've got, just so I make sure I got everything. But yeah, that was really great. And so for everyone who's watching from home, I mean, we all are, but for everyone who's watching from home, I just want to say thank you for coming tonight. And I also wanted to invite you to our Black History Month Kahoot night. It's going to be Friday, the 12th of February, from 3 p.m. to 4:30 p.m. And it's going to be a really, really great time. We hope to see as many of you there as we can. And yeah, that's it. Hope you all have a lovely rest of your night. Good night.
Awesome. I also left my email and my Instagram handle in the chat.
Yes, and we
And
will
go
post
up.
both Julian and Angel's information on our Instagram later after this event is over.